Truck drivers across Canada are getting hit with CRA reassessments. Some are being asked to pay thousands in deductions they claimed years ago. If you are an owner-operator or incorporated driver who has been filing the same way for years, CRA has surprise for you in 2026. They are no longer accepting these claims by default. The rules did not change, but the enforcement did. And in this video, I'm going to show you exactly what changed, what CRA is looking for, and how to protect yourself. Hi, I'm Armagan. I'm a CPA in Canada who loves to talk about money, investments, and taxes. If this is something you are interested in, why not subscribe to the channel? One quick note before we dive in. This video is mainly for incorporated truck drivers, owner-operators, and trucking companies using contractors. If you are an employee driver with a T4, your situation is different and this video might not apply to you. So let me start with how most people in the industry have been filing their taxes for years. Long-haul drivers can claim a flat daily meal allowance. You do not need to keep every single receipt. This is the simplified method. You add up your eligible travel days, multiply by the allowed amount, and that becomes your deduction. This has been a standard practice for a long time. Accountants have filed it this way, tax softwares have supported it, CRA rarely challenged it. The belief became that as long as you were a long-haul driver, putting in the miles, you were entitled to the deduction. No further questions asked. And honestly, that belief was not unreasonable. The rule is real. The simplified method does exist. The problem is that the rule has conditions that the industry has been glossing over for years, and CRA has now started paying more attention to this. So then what the rule actually requires? The simplified meal allowance is not automatic. It applies to eligible long-haul travel only. CRA defines a long-haul driver as someone who transports goods at least 160 kilometers from their employer's establishment and who regularly has to be away for at least 24 hours to make deliveries. That last part matters. You need rest periods built into your trips. You need trip logs that show routes, distances, and overnight stays. And those logs need to be consistent with your claims. For the 2025 tax year, the CRA's simplified method allows $23 per meal for long-haul drivers. That's breakfast, lunch, and dinner, with 80% of that amount deductible. So let me put that into real numbers using the 2025 rules. If a driver claims 200 eligible long-haul travel days at the maximum rate, that works out to be a roughly $11,000 in meal deduction for the year. So let's put this impact into context. Most long-haul owner-operators fall into a marginal tax rate somewhere between 30 and 40%, depending on their income and province. So if CRA disallows roughly $11,000 in meal deductions, that alone can translate into $3,000 to $4,500 in additional taxes for a single year, and that's before interest. If multiple years are reassessed at once, the number adds up very quickly for the truckers. So then you would be curious as to see what has changed in 2026. The law did not change, the wording did not change, but the enforcement did. CRA has increased targeted audits across many areas, and the trucking industry is one of them. Reviews that are happening today are far more detailed than they used to be, and reassessments are being issued retroactively, sometimes going back several years. Claims are being denied when documentation does not clearly support eligibility, and in practical terms, the bar for documentation has gone up. So you should understand that CRA is no longer accepting these meal deductions by default. Now let me explain how these cases are being identified by CRA. They do not randomly pick files. Reviews are typically triggered by patterns. Consistent flat meal claims year after year can attract scrutiny. Corporate income structures that are common in trucking receive closer review. T4A reporting creates clear income trails that CRA can cross-reference against corporate and personal tax filings. The infrastructure for record keeping in the trucking industry has also evolved, and CRA is far more likely to request trip logs, routes, distances, and supporting documents during an audit. If your meal deduction claims cannot be supported by documentation that aligns with your actual trips, CRA is much more likely to deny those claims today than it was in the past. So let me walk you through the patterns CRA is catching most often nowadays. First, assuming that all long work days automatically qualify. They do not. The eligibility is based on distance from your employer's establishment and overnight travel requirements. Long hours alone do not make you eligible for simplified method. Second, weak or inconsistent travel logs. If your logbook shows you were home every night, but your tax return claims 200 days of meal allowances, that is a problem. Third, claiming the allowance without verifying eligibility for each trip. Not every run qualifies. Local hauls typically do not count. Fourth, relying on industry standard. instead of CRA definitions. Just because everyone in trucking files this way does not mean CRA will agree with it. Fifth, and this one is important, some drivers think that they can choose between the simplified method and actual receipts based on whichever gives them a bigger deduction. CRA expects consistency. You pick a method and stick with it. Switching back and forth to maximize your claim is a definite red flag. So you should understand that these are just common mistakes, not bad intentions, but CRA is treating them as compliance failures all the same. If you are still working as a long-haul driver, here's what I recommend. First, confirm whether you actually qualify under CRA's definition, not the industry definition, not your accountant's definition, but CRA's definition. That means 160 kilometers from your employer's establishment and regular overnight stays. Second, fix your record keeping going forward. Keep trip logs that show dates, routes, distances, and rest periods. Make sure they are consistent with your meal claims. Third, review your prior filings before CRA does. If you have been claiming meal deductions that may not hold up under scrutiny, it is better to address that proactively than to wait for a reassessment. Fourth, get professional advice before an audit starts, not after. Once CRA sends a letter, your options narrow quickly. A tax professional can help you understand your exposure and prepare your documentation. This is not about stopping deductions. You may still be entitled to significant meal deductions if your trips genuinely qualify. This is about claiming them correctly with documentation that supports your claims. There is a link in description below if you want to work with me on this. So what if you have already received a letter from CRA? My first recommendation is do not ignore it. CRA letters have deadlines. Missing those deadlines limit your options further. Also, do not panic. Each case depends on its facts and documentation. A reassessment proposal is not a final judgment. Early action gives you more options than late reaction. If you have documentation that supports your claims, a tax professional can help you present it properly. If your claims do not hold up, there may still be options to reduce your penalties or negotiate payment terms. I'm not going to promise any particular outcome. Every situation is different, but I can tell you that the worst strategy is to do nothing and hope it goes away. It will not go away. So let me bring this back to a big picture. This is not a new tax on truckers. It is not a political attack on the industry. It is a compliance shift that the industry needs to understand. For years, CRA enforcement was lax and the industry adapted to that reality. Now, enforcement has tightened and the industry needs to adapt again. The videos on the screen will help you understand more about how self-employment taxes work in Canada. Check those out and I will see you in the next one.